10 a.m. break time here, February 14th. Happy Valentine's Day, Ryan.
Happy Valentine's Day, Jeff.
It's also, my kids have today off and Monday off for the Lincoln's birthday today and Washington's birthday on Monday. So they have what we used to get when you get the double holidays versus just the single President's Day holiday that we have now. I know, Ryan, I know your kids don't. So it's just interesting that the difference is the school district.
Try and keep us on our toes.
Oh, yeah, exactly. We never know. All right, let's get into the where are we for the week. And it looks like stocks turned in. We're up about 1.5% on the week on S&P as of time of recording. One negative sector on the week, healthcare down 0.5%. The other, it looks like the big winner is tech, up almost 3%. You have materials up 2.3%, and comm services up 2.25%. So a pretty wide dispersion there, but a good week for the S&P, up 1.5. Looks like the index is the second loser, up 20 basis points. So that's the second loser there. If we shift focus, Russell 1000 up 1.3, so kind of almost keeping in line there with the S&P. Russell 2000 was flat on the week. Growth was up 1.3%, and value up just over 0.75% there. So it's almost like the themes of 2024 have come back to play here in, at least for this week, the second week of February. If look at a broad-based S&P equal weight up 70 basis points on the week also. Looks like we're positive on the month, positive 1.3% on S&P on the month. S&P equal weight is flat on the month. So those larger cap names have continued to outperform on at least so far in February. Shifting our focus to the bond market, 10-year Treasury was down 3 basis points to 4.47 as of time of recording. 4.47 the time of recording. Long bond at 4.69, flat on the week, and the 2-year is actually down 4 basis points. The biggest yield curve move across your on-the-run Treasuries is that 2-year. As you would expect, the decrease in rates led to positive performance across the board for fixed income indices, agency mortgages, and investment-grade corporate bonds were your best performer, up slightly over 0.5% there. High yield up 0.25%. Bank loans are up 10 basis points, right in line with EM there. So positive across the board for all the fixed income sectors there. And looks like year to date, we're ags up 1.2%. So holding in there pretty good from overall return perspective from the fixed income market. Shifting focus, finally, commodities. Commodities have a good week. Bloomberg Commodity Index up 1.8. Month to date up 3.8. So a good month so far and a good start to the year with the commodity index up 8% there. On a week to date basis, energy, your best performer, up 3.7. Ags up 1.6. Precious metals up 0.75%. And your worst performing sector is your livestock. That's flat on the week there. Looks like WTI crude's at $70 a barrel, kind of hanging in there in that range, up 25 bips on the week. Copper up 2%, and then gold at $28.83 continues its tear, up 9.3% year to date, and another 50 basis points this week here. So your commodities are doing well, at least on the week. Everything positive on the week. Ryan, I don't know what else you would like to talk about from the market perspective, but I think we covered the basics. Nothing really stood out, I didn't think, on the week. It seemed like it was as far as these things go, a pretty normal week.
Yeah, I mean, it was a bit of an up and down, or down and up, I'd say, for the bond market, just based on the whipsaw we've seen in the inflation data, which we'll get into in the macro section of the call.
Yeah, if you were a day trader, you could have got whipsawed there. But yeah, why don't we get into kind of inflation week and what we saw and what moved markets.
Yeah, so as I was saying, the week was really revolved around the inflation data that we got. We had a number of inflation focused prints. You had CPI on Wednesday, producer prices on Thursday, and then we had import prices this morning. I'll start with CPI, probably the most closely followed inflation report from the economic data releases, and it was definitely market moving. So on Wednesday we got the January report for CPI, which came in much hotter than expected. You had both the headline and core number core excludes the volatile food and energy components. And I think what was interesting is heading into this January number, we were passing around some analysis amongst the team, just showing that I think it was like out of the last 15 years, 14 of the January um, releases came in hotter than expected. So there does appear to be some residual, seasonality in the data. It's one of those things. It's like fool me once, shame on you. Fool me 14 times, maybe shame on me.
Maybe they need to adjust their seasonal factors. That's what I would say.
It's looking like that, isn't it? And it's understandable. It's really hard to come up with these seasonal adjustments. There's these, beginning of the year or turn of the year, one-off price changes that, you tend to see in January. So, I understand their pain, but it does make for some significant misses, some persistent misses. And, I'm not jealous of all the economists that have to come up with these, monthly CPI forecasts. But just kind of digging through the numbers, the headline CPI, we saw that grow 47 basis points month over month. That was well ahead of the 30 basis points expected by the markets. And this was the highest monthly growth rate since August 2023. And then this did bring the year-over-year change back up into 3%. So we're back into the 3 handle in the headline number. For core CPI, we saw a gain of 45 basis points on the month, well above the 30 basis points consensus, and the strongest pace since April 2023. And this kept the year-over-year pace at 3.3%. And so it's been unfortunate that at least on the core number, it's the disinflation on the year-over-year basis has really kind of stalled out over the last 6 months. I think we're like at the same year-over-year rate we were back in June of last year. So it's really seeming like the last mile on inflation getting back down to 2% is becoming quite challenging, to say the least. Some other fun facts that I saw in the report. So the super core number, this is core services ex shelter. This is the sector that the Fed seems like used to focus on, but that surged 76 basis points on the month, bringing the year-over-year pace to 4%, which sounds like a really high number, but this is actually an improvement from where we were a couple months ago, where we were in the high 4%. I'd say on the positive side, though, and this is a dynamic we've been highlighting, is that the owner's equivalent rent in the shelter component, this tends to be a bit more of a persistent component within the CPI basket. That rose 31 basis points, which was similar to what we saw last month. But notably, it was much lower than we were in January last year. We're seeing like over 50 basis points month-over-month growth rates. So that does point to perhaps, this, important shelter component getting back to, a pre-pandemic level, which should help on the surface, it should help get us, back towards 2%. And then I thought this number was interesting, especially for our listeners, because it really hits home. Egg prices, they were up 53% year over year. I'm sure most of us have gone to the grocery store and felt that hit when we see those prices in our wallets. If you can find eggs to begin with, but I thought that was a pretty interesting number to showcase. And so as I was saying, following that CPI print, we did see Treasury sell off, and then they began to reverse a few hours later. And then I thought it was interesting on Thursday, the following day, we got producer prices, and the market reaction was kind of interesting. So the headline number in aggregate came in hotter than expected. You had both the headline, the final demand number, up 40 basis points. That was above the 30 basis points consensus. And year over year rose to 3.5%. And then you had core PPI, which includes food, energy, and trade. Those are the more volatile components. That came in at 32 basis points positive on the month versus 20 basis points consensus. And that left you at a 3.4% year over year number. But the Treasury market rallied following that, and that is because the components in PPI that feed into PCE prices were actually on the soft side. So it's looking like, based on the PPI components and the import price components that we got this morning, that we could get, or economists are modeling a softer or soft-ish PCE print for January. So that we get that number at the end of February on the 28th. And I've seen some economists, forecasting the January PCE print to be around like 25 basis points month over month to 26 basis points for core PCE. So that could get you to perhaps a 2.5 year over year, 2.6 year over year, which a big improvement from the 2.8 we currently have as of December. So definitely we'll be watching that number as it comes out.
Yeah, 2.5 almost sounds like 2.
Yeah,
Sounds like the Fed is making progress here. I agree. It was interesting because your first reaction was like, oh, the headline PPI is hotter on the base, and it was kind of, I would say, the market almost expected that based on the higher CPI print from the previous day. And as you said, once they got into the details, it was like, oh, things are going to be softer. And it's basically the market movements that happened on Wednesday just got reversed on Thursday. And so, if you look at the 10-year, it was up 9 basis points on Wednesday and down 9 basis points on Thursday. So right back in there. And it was interesting. Just usually when we look at it and we're like, people are tearing things apart, and it's to try to fit their narrative. But this time, actually tearing it apart and looking into it led to some, I guess, more positive news than usual.
Yeah, exactly. So it definitely led to that whipsaw that we were talking about in the treasury markets throughout midweek. We also got jobless claims on Thursday. It was in the low 200K on the initial claims, and continuing claims kind of continues to run at this very muted pace. Nothing really to see there. No real stress in the labor market from that higher frequency data point. We did get retail sales this morning. That headline number and kind of across the board, all the components were weaker than expected. It does look like perhaps the LA wildfires and the severe winter weather we saw across the country might have had a negative impact. Our colleague Mark Kimbrough pointed out an interesting factoid that the auto sector detracted 56 basis points of that negative 88 basis point headline number. So it was a bit concentrated. But that being said, the control group, which is, the component that's used to outcalculate the goods component in GDP, that was down 82 bips on the month. So definitely not a strong read to start the year.
Kimbrough was looking for those green shoots.
Yeah, exactly.
And the retail sales, trying to take that the green shoots moniker from another member of our team who tends to be very positive about things.
Yeah. So, obviously one data point, not going to read too much into a material trend shift here. I'd say the consumer, from the aggregate data that we look at, still looks relatively strong. And then we had industrial production. The headline, a bit stronger than expected, up 50 bips versus 30 basis points consensus. But the underlying details are kind of weak. Manufacturing production decrease. That was driven by a decline in auto production. And so that headline number is really supported by a surge in utilities, which is up 7.2% on the month. And that was largely due to the extreme cold that was experienced in the Northeast. So not reading too much from that hotter or better than expected headline number. And that really wraps up the week in economic data.
Yeah, and if we shift focus for a second over here to the Fed, Jay Powell was in front of Congress both Tuesday and Wednesday in what was formerly known as the Humphrey Hawkins testimony. On Tuesday, it was pretty much nothing was going on. His most I've seen like the thing that people latched onto was when Powell said, we do not need to be in a hurry to adjust our policy stance. And that was it. That's kind of the same thing he's been saying, or he said at the last Fed meeting. And then we were joking on Wednesday on the desk whether Jay had the early look on the CPI data, because certainly we wouldn't know. He obviously knew CPI was coming out the next day, so he wouldn't want to say anything about about inflation coming down when that hot data print was coming the very next day. But on Wednesday, after that data print was public, people, there were more questions about it, and basically Jay said that he said, I would say we're close, but we're not there on inflation. And also this is something that we always harp on, is that we don't get excited about one or two good readings, and we don't get excited about one or two bad readings. So even though we say 2 data points make a trend, we're really looking for those 3, 4, 5, the trend continuing to build upon itself before really reacting to that. And after all this, after the CPI, after the testimony, we're still at 1.6 rate cuts market has priced in for 2025. The first rate cut, though, is kind of pushed out a little bit. We're at like 80% chance of a rate cut in July, and then we finally get over 100% in September. So September is the first month where it's over, market's pricing over 100% probability of a rate cut. But you look at it, and then really the market doesn't know when a rate cut's going to happen. It's like 20% in May, another 37% in June, 23% in July, 33% in September. So it's like their market's like, okay, we're going to get a rate cut one of these times, but they don't really know where or when. And it's really going to depend on whether or how the data shakes out. So we'll keep everyone apprised of that. With that, let's move on to the things to keep an eye on for next week. It is Monday as a holiday. As I mentioned at the top, President's Day. We get the Fed meeting minutes on Wednesday. Shouldn't be anything. I would say there's not really anything to look forward to there. We'll see kind of what color the Fed wants us to think they were talking about in their meeting. Jobless claims as usual on Thursday. And then we also get the leading index on Thursday. That's we have a 0.5 rolling off. So that's should lead to a pretty positive movement in the year-over-year number, because their market is expecting, or economists are expecting a 0.0 number. If we got that, then the year-over-year number would get to a negative 2.5. And it'll be interesting to see if we get to that negative 2.5, how the conference board starts talking about how to interpret their data again, whether that whether that's positive and negative 2.5 is now positive, or how that's going to happen. And so we'll see. We always like to read the commentary there. And then on Friday we get the S&P Global. We get the manufacturing and services PMI. These are the February preliminary numbers, which is always funny that they come out, with another week left in the month. So who knows what would happen at the end of the month. But they're expected to be, or last month, the manufacturing was positive 51.2, or positive. It was at a 51.2. Services at 52.9. Composite at 52.7. So we'll see whether we get back down negative or those stay positive across the board there. So pretty light data week for a short week. So that'll hopefully give us a little respite of things or respite from the volatility that we've been experiencing both in the stock and bond markets. And with that, I think that wraps it up for this week. I'd like to thank everyone for listening.
Yes, thank you all to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget our website, DoubleLine.com. YouTube channel is youtube.com/DoubleLine Capital. We got the latest episode of Channel 11 out there with our portfolio manager, Ken Shinoda. It's a pretty short listen, but it's good. Ken always has good charts and good perspectives on things, so I always like to listen to what he's thinking about. So again, thanks for tuning in. Hope everyone has a great long weekend.